Debt is the enemy, right? Wrong. What if I told you it could be your greatest financial ally? Did you know that some of the world's most successful entrepreneurs and investors use debt to fuel their growth and make millions and even billions? It's true.
So how do I get rich? I borrow money and I buy assets with it.
But how? In this video, we will reveal the 6 smart ways you can use debt to your advantage without falling into the debt trap. So if you're tired of feeling trapped by debt and ready to explore alternative strategies, stay tuned until the end. Now, let's get straight to the point. Many folks view debt as a means to acquire things beyond their immediate cash reach. Think cars or houses.
The poor person borrows money and buys liabilities like purses, cars, houses, and they get poorer and poorer and poorer. But I use debt. I borrowed $300 million after the crash, dollars. In 2000, by 2010, I had borrowed $300 million to buy real estate.
They then spend years, even decades, clearing this debt to eventually own what they purchased. However, for the wealthy, debt is merely a tool, enabling them to achieve what may be unattainable alone or accelerate their accomplishments. To them, debt equates to additional resources for growth and greater achievements. Number 1. Enhance or expedite the growth of your business. One common practice is using debt to enhance or expedite the growth of their businesses. Businesses invest in things like hiring new staff or opening more locations. They might also create debt with other companies to acquire products or supplies on credit when they're not ready to make the full purchase or have other financial priorities. Take Steve Jobs and Apple as an example. In their early days, Jobs secured a significant sale to the Byte Shop, selling 50 Apple I computers. Here's the catch. He didn't have the parts needed to build those computers, and he lacked the funds to buy them outright. So he approached a computer parts company seeking to get the needed components on credit. Since he had no established credibility, Jobs had to present the purchase order from the Byte Shop to secure the parts on credit. He succeeded and fulfilled the order, and that deal brought Apple its first $25,000 in the 1970s, equivalent to around $115,000 in today's money. Now, if used incorrectly, debt can really hurt our finances. It's a no-go to use debt to kickstart a business, especially if you're new to the game. Wealthy folks, on the other hand, invest their time and resources to truly understand the ins and outs of debt, figuring out how to make it work for them. Number 2. Leveraging debt to increase your wealth. The second move by many well-off individuals involves leveraging debt to increase their wealth. While most investors simply put their hard-earned money into a portfolio, some opt for leverage. That's essentially using debt in their investment portfolios to amplify their earnings. It's a bit more strategic and a path chosen by those in the know. Consider our pals Tom and Jerry diving into investments. Tom invests $100,000 with a 10% annual return, netting him a $10,000 return on investment. Now Jerry throws $100,000 into the same portfolio, but spices it up with a 35% leverage, giving him a total of $135,000 in his portfolio. $100,000 of his own and $35,000 borrowed. With a 10% market return, Jerry rakes in $13,500, trumping Tom's $10,000. Jerry's return on investment surges to 13.5%, beating the regular 10%. Exciting, right? But hold on. This method, while promising higher returns, dances with higher risks. Now let's flip the script. Imagine the market taking a nosedive by 10%. Tom would lose $10,000, but Jerry? Well, Jerry's in a tighter spot, losing over $13,000 since his portfolio is technically larger than Tom's. While it heightens risk, leverage is a go-to for sophisticated investors and hedge funds aiming to amplify long-term profits. Beyond just leveraging, there's another strategy in play. Even when markets are on the decline, it's called shorting. In this method, institutions or individual investors don't borrow money, but opt to borrow stock from a brokerage firm. Let me break it down for you. Imagine an investor who forecasts that Company X is heading for a downturn. They borrow Company X's stock valued at $100, not as debt, but as one share of Company X. Swiftly, this investor sells the share in the open market for $100, pocketing the cash. Lo and behold, their prediction hits the mark. Company X faces a scandal. Shares plunge by 85% within days, and they're now worth a mere $15. So our investor starts with $100 from selling a share, and they take $15 to buy back the stock at a sweet discount. Returning the stock to the broker, they pocket $85 as profit, tossing in a bit for borrowing it. This move is how many investors and big players like hedge funds make cash when the market is on a downward spiral. But let's be real, this strategy is playing with fire. When you toss $100 into the stock market, your worst case scenario is losing that 100, and that's if the company tanks to zero. Now, if you decide to short a stock, your losses can, in theory, go on forever, because there's no cap on how high a stock can climb. Number 3. Velocity banking. Another unique method of leveraging debt for wealth accumulation involves the application of velocity banking. This financial strategy hinges on the strategic use of a line of credit, typically a home equity line of credit, to optimize debt repayment and concurrently invest in income-generating assets. The process begins by securing a line of credit and consolidating higher interest debts, such as credit cards or loans, under this lower interest credit line. The individual then channels their income directly into the line of credit, temporarily inflating its balance and reducing interest payments. Daily expenses, including bills and groceries, are covered using the line of credit, redirecting the individual's income toward debt reduction. Simultaneously, the funds in the regular checking account, traditionally allocated for daily expenses, become available for investment opportunities, ranging from real estate to stocks. This cyclical process continues as income consistently flows through the line of credit, optimizing interest savings and expediting debt repayment. Velocity banking demands financial discipline and a comprehensive understanding of interest rates and market dynamics. While it offers a unique approach to utilizing debt for accelerated debt reduction and wealth creation, its applicability varies based on individual financial circumstances, risk tolerance, and market conditions. Seeking advice from a financial professional is advisable to align velocity banking with one's specific financial goals and ensure its suitability within their broader financial strategy. Ultimately, velocity banking represents a nuanced method of leveraging debt strategically, emphasizing the efficient management of borrowed funds to simultaneously expedite debt payoff and capitalize on investment opportunities, contributing to long-term wealth accumulation. Now, there are more conventional ways folks utilize debt to build wealth. Number 4. Invest in real estate. Real estate stands out as one of the most common methods. It allows the average person to buy property without having the full amount up front. This enables investors to own a property, turning it into a cash-flowing asset. By borrowing money, they leverage a larger asset, letting others cover their debts, build equity, and generate positive cash flow. Now, for those shrewd investors out there, a couple of other strategies can help grow your wealth. Consider this scenario. We acquire a property for $300,000. A strategic move involves placing a $40,000 down payment and financing the remaining $260,000. While it might not be the fanciest property, it's strategically located in a booming local market. To enhance its appeal, we invest an additional $10,000 to spruce it up. Taking advantage of the prime location and the upward market trend, we opt to reassess our property, and voila, it's now valued at $360,000. Armed with this updated figure, we head to the bank for a refinancing option. We can either bolster our property's equity with the extra $60,000 or cash it out. Essentially, we're leveraging our assets, borrowing from ourselves to invest in another lucrative property and continue expanding our wealth. Number 5. Borrowing money at a low interest rate to finance a purchase. When it comes to leveraging debt to build wealth, there's a strategy that makes sense, especially when interest rates are low. Consider this: borrowing money at a 2% interest rate to finance a $50,000 car. Instead of paying upfront in cash, it might be wiser to finance the purchase. Why? Well, if you take that $50,000 and invest it in the stock market with an average rate of return of 10% per year, your returns could surpass the interest paid on the loan. For instance, imagine a 5-year loan at a 2% interest rate for your car. The total payment, including interest, would be $52,583. Now, if you had invested that same $50,000 in the stock market over those 5 years, it could have grown to $80,525. A profit of nearly $28,000, all thanks to the judicious use of debt. Number 6. Buy, borrow, and die. Now let's talk about how the wealthy handle their finances, especially when it comes to taxes. They've mastered the art of leveraging debt to minimize their tax burden. Here's the game. When you're preparing for retirement, you typically let your assets grow, and when it's time to retire, you sell or use the cash flow from your assets to fund your lifestyle. But, and it's a big but, this means you'll be hit with taxes on that money. Let's say you've amassed a hefty $30 million real estate portfolio. You've worked hard, and now it's time to kick back and enjoy the rewards. You decide to sell a property, making a sweet $10 million profit for your retirement. But here's the catch. That sale triggers a $2.3 million capital gains tax to the federal government. And because you're in California, tack on another $1.3 million in state taxes. That's a whopping total of $3,754,365 in capital gains tax. Suddenly, your $10 million profit shrinks to $6.2 million. Almost 40% of your gains went straight to taxes. Now, let's talk about investments. Losing 40% to taxes doesn't sound appealing to any investor. So instead of selling the property, you opt to borrow those $10 million, leveraging your $30 million real estate portfolio as collateral. Here's the tax-savvy move. Debt isn't considered income, and it's not taxable. This means you get to enjoy your millions without facing capital gains tax. Sure, you borrowed money and repayment is on the horizon. This is where savvy investors utilize another tax loophole, the step-up basis, to wipe out the need for taxes. Ordinarily, when you sell an asset that is appreciated, capital gains tax awaits. But with the step-up basis, passing assets to your kids adjusts the starting value to the current market value. For instance, if you bought a property for $100,000 now valued at $400,000, you've got a $300,000 gain. If you were to sell, taxes would come into play. However, with the step-up basis, when you pass the asset to your kid, their starting value is set at $400,000. If they sell at that price, they're in the clear. No taxes because technically, there was no profit under their ownership. It's a smart play in the world of investments. This approach goes by the name buy, borrow, and die, a tax-saving strategy where you use your money to acquire an asset, borrow against it for your expenses, and eventually pass it down to your heirs using step-up basis, ensuring they can sell the asset without tax consequences to settle the debt upon your death. The advantage here, beyond tax avoidance, lies in the continuous growth of your assets since you don't sell them to fund your lifestyle. By borrowing instead of selling, your asset keeps appreciating, resulting in more money in the end. It's clear that debt, when used wisely, isn't always a financial setback. Of course, it can pose risks if mismanaged. Thanks for tuning in. If you enjoyed the video, give it a thumbs up and subscribe for more. Catch you in the next video.